Hi, Ronnie. Thank you very much for joining us today. How are things in Vienna?
Very good. Thanks for having me, Jim.
Ronnie, 2022 has been a fascinating year with the S&P down 20%, the NASDAQ down 30%, and Bitcoin down over 50%. Trillions of dollars have been wiped out, and I want to touch on all of these subjects. But before we do that, why don't we just start with a brief overview of your firm, Incrementum? Where is the firm based, and what services does it offer?
Well, we are based in Liechtenstein, which is a very, very small country in the center of Europe, 35,000 people living there. It's one of 5 countries worldwide without any government debt, so that's pretty fascinating. And it's a beautiful, beautiful place. And we are 2 partners from Switzerland, 2 from Austria, 1 from Germany, and we basically met in the middle in Liechtenstein. So what do we do at Incrementum? First of all, wealth management for high net worth individuals. Then we do manage 6 investment funds, most of them in the precious metals and commodity space. So we've got 1 uranium fund, we've got 1 mining fund. I'm managing a inflation protection fund. We've got 2 funds that combine gold and silver in general with Bitcoin. So that's definitely very unique. And I think most people know us because of our In Gold We Trust report. I started publishing this report almost 15 years ago when I was still a young kid sitting in a bank without any clue about the monetary system, about gold, no clue what sound money is, no clue about the Austrian economics. So over the last 15 years, yeah, we wrote lots of research about the topic of gold, and the In Gold We Trust report is nowadays probably the most widely followed publication on gold. So we publish in German, English, Mandarin, and also in Spanish. And for the last edition, we almost had 2 million readers. So it's really a quite a success nowadays.
The title of the latest edition of In Gold We Trust is Stagflation 2.0, and the last time we had stagflation was in the 1970s. Can you just expand on why you chose this title?
Well, actually, we chose this title already in fall 2021. And back then, stagflation wasn't really a big topic, but we said, well, actually, the way inflation is developing, we didn't really believe that it's only transitory. And let's not forget, until very recently, all central bankers basically told us, it's transitory, it's gonna come down. Christine Lagarde said it's only a hump, so it's a hump. Yeah, I said, well, it's a very, very big hump, like the Himalaya. But we were quite critical, and we said, well, actually, there's lots of structural drivers for this inflationary pressure that we're seeing. I mean, it's obviously the deglobalization that is happening. It is structurally, we're seeing that fiscal stimulus has a much more direct impact on inflation numbers compared to monetary policy, and then obviously lots of pressure coming from the labor market and so on. So we said stagflation will become a topic, and then we read quite a lot about stagflation and realized actually there is no quantitative definition of stagflation. So it's mostly qualitative, and so we came up with our own definition of stagflation, and we came up with an indicator for the strength of stagflation, and then crunched the numbers and researched what works in stagflation and what doesn't work. So that was basically the reason. And why stagflation 2.0? Because obviously history repeats and it rhymes, but and there's lots of similarities between the current setup and the setup in the 1970s, but there's also many differences. And I think the major difference obviously is the level of debt. So on a corporate level, on a private level, but also on a government level, debt levels are significantly higher, twice or even 3 times as high compared to the 1970s. So I just don't believe that Jay Powell is the new Paul Volcker. I just don't see it, because obviously due to this enormous debt burden, the sensitivity to rising interest rates is so much higher than when Paul Volcker was around, that we are already seeing at the moment that so many markets, so many different pockets of the market are already breaking. So I think this would be the major difference between the stagflation of the 1970s and the current stagflation.
You've mentioned in the past that there are three phases of inflation: monetary inflation, asset price inflation, and consumer inflation. The Fed has lifted interest rates 5 times since March. Do you think they've been successful in bringing down consumer inflation?
So far, they haven't been, yeah, because obviously CPI hasn't come down really. PCE, or core inflation, didn't really come down either. But I think, I mean, let's take a step back, Jimmy, and I think it was really the article and also some interviews that Bill Dudley, former I think vice chair of the FOMC and head of the Federal Reserve New York, he did basically explain it already in April with his thoughts about the so-called reverse wealth effect. So basically, the game plan of the Federal Reserve was, well, we cannot really solve the energy problem. We cannot solve all the issues that we have on the supply side. So actually, we have to tackle it from the demand side. So through this negative or reverse wealth effect, by bringing down asset prices, equities, bonds, and also real estate, they wanted to influence aggregate demand, which leads to a soft landing or a mild recession. So that was the game plan. And actually, I think this plan already sounds pretty, let me find a polite word, creative and let's say interesting in theory. And from my point of view, there's no way that this will really go out well. And just to give our audience a perspective, since the beginning of the year, 60 trillion globally were wiped out in equity markets, in bond markets, in real estate, in commodity markets, in the crypto market. 60 trillion, that's I think roughly 65% of global GDP. That's a huge number. So actually, on an absolute basis, this is the biggest destruction of wealth ever. Now, obviously, people feel less rich. People, stop purchases. They reconsider their spending behavior and so on. So that obviously works, but it also causes enormous problems for, let's say, parts of the market that were already under some stress. Now, in 2020, one of the biggest shocks in recent history, actually fiscal policy bailed us out, and there were basically no bankruptcies in 2020, and already in 2019 I wrote that a recession is on the horizon. I didn't know that COVID would be the trigger and the catalyst, and obviously I didn't expect a virus to appear from a laboratory in Wuhan or wherever. However, the recessionary clouds were already kind of gathering. Now in 2020, the recession happened, triggered because of the lockdowns, and then still fiscal policy stepped in. So my take has been that actually all those zombie companies and also zombie consumers, they got a bailout. But still, they are very, their fiscal or their financial stance is very, let's say, fragile. And I think, you know, this fragility is kind of now appearing in this development. As I've said before, we've got the highest debt levels ever. Therefore, the sensitivity to rising rates is higher than ever. And, you know, let's face it, 1 year ago, interest rates were at 0. Now we are heading to 4.5. Some analysts are even expect 5% by the middle of next year. So that's a huge move on the rate side, and I just don't see this ending in just a mild recession or in a soft landing. I just don't see it, and I think the consequences or the effects that we're seeing now in financial markets. We saw major troubles in the British bond market. So actually, the pension funds in the UK got a bailout from the Bank of England. We see huge cracks appearing in Japan. We see that major banks like Credit Suisse, but also Deutsche Bank in Europe are under severe stress. Just have a look at their CDS. So actually, those are the consequences of the rate hikes and the tightening that already happened over the last couple of weeks. Now, if they continue with that policy, we're not talking about a recession, we're talking about a depression. So I think, you know, the pivot will come at some point. I don't believe the narrative that the Federal Reserve is now being ruled by hawkish Jay Powell. I just don't see that. But I think they're completely underestimating the time lags that are involved, and therefore, you know, I think it's gonna be interesting over the next couple of weeks, to use a very diplomatic word.
You touched on the US dollar and the US dollar index. It's up 15% on the year, give or take. Where do you see it going?
Well, I did a fireside talk with my friend John Hathaway at the Precious Metal Summit recently, and back then I think the Dixie index, which is very much driven by the euro, I think it's 54% of the weighting. I think back then it was trading at 106 or 107, and I said it can go to 120, and people said, well, that's a pretty gloomy forecast. And actually we went to, I think, 115, 116 within the next 2 or 3 weeks. So from a technical point of view, I could see some sort of a bear market rally in the euro, but from a longer term view, I just don't see any secular strength, euro versus US dollar. I think what's interesting, Jimmy, is the fact that the US dollar is so strong versus the Japanese yen. And I always said, if you want to know the future of monetary policy, just look at what the Bank of Japan is doing. They're a couple of steps ahead. So the Japanese yen is, you know, that's like really the 8th or the 9th inning probably of this monetary end game. But then it's also the weakness in the euro and also in the British pound. So I mean, those are not three unimportant currencies: the yen, the euro, and the British pound. However, versus, for example, the Brazilian real, actually the US dollar is trading kind of flat. And I could see strength of the US dollar going forward versus most other G7 currencies, but weakness measured in commodity terms. So this is a little bit of a the forecast that I have for the next couple of weeks, or for the next couple of months actually. And obviously everybody is just waiting for the big pivot coming from the Federal Reserve, and this would go hand in hand with the peak in the US dollar. I'm not so sure about that. I think the dollar could also die because of its strength and not because of its weakness. So perhaps, you know, if we read monetary history, you know, we had like the Plaza Accord meetings, for example, because of the strength in the US dollar. And it was a kind of similar setup with what led to the Plaza Accord. So I think that something like that could happen within the next 2 or 3 years.
So we discussed interest rates, we touched on the US dollar and also inflation. Why don't we bring all of these elements together and discuss their impact on gold? Oil went to $125. Copper's traded up to $5 a pound. Bitcoin's gone up to $68,000. And we've always been taught that one of the benefits of holding gold is its protection against inflation. But in spite of all these moves that we've seen in these other asset classes, gold really hasn't moved. Why?
The thing is, I think that gold is doing just fine. Gold is, for example, this year to date, in euro terms, gold is up 8%. In Japanese yen terms, it's up 17%. In British pound terms, it's up 14%. In dollar terms, it's down 5%. So actually, obviously, the US dollar was the big topic this year. And if you got the dollar right, this year you had a fantastic year as an asset manager. Now, you mentioned the enormous drawdowns that we saw in basically all asset classes, and you know, equities are down, especially the tech stocks that, you know, everybody said, well, this is like the nifty 50s of today's world. You cannot do wrong with buying the ARK ETF or buying Tesla, Facebook, Alphabet, whatever. But now we're seeing, well, actually those drawdowns are pretty significant. We saw it in the crypto space, obviously. We saw it in the bond market. I mean, the global bond markets have their weakest year since the year 1865. So that's pretty significant. Now, gold, I think it's, you know, expectations were perhaps a little bit too high. But I think that in hindsight, I have to say, you know, let's be frank. If you would have told me last year, or if you would have asked me last year, you know, inflation is at 8%, there's a war in Europe, where would you see the price of gold? I probably wouldn't have said 1700. To be honest, I would have expected a little bit more. However, as I've said before, 60 trillion drawdown in global asset prices. I think we're now a little bit in this environment like in 2008, where actually gold was up big time, made new all-time highs. And then in those very, very turbulent weeks in September and October, it traded down and ended the year still, I think, with plus 5 or 6%, while everything else was down. Because gold, first of all, it was liquidated. Institutional players, funds, but also private individuals just needed liquidity. And what do you usually sell in such a liquidity event? Whatever asset is very liquid and has a small bid-ask spread, and gold, you know, it's one of the most liquid assets out there. Its trading volume is 140 billion per day. So I think that's one of the reasons. And then obviously, I think that gold is already kind of sniffing out this pivot that will happen at some point. So that makes me pretty confident going forward for gold.
So as you mentioned, gold is down small on the year, but many producers are down 20, 30% or more. And a lot of them have little or no debt. They're cash flowing, they're buying back stock, they're paying dividends, but they're down significantly more. Why?
Well, obviously, you know, price of gold is down, and still many companies are experiencing inflation on the cost side, not only labor, but also all sorts of materials. Obviously, energy is a huge driver. However, as I've said, I did visit the two big mining shows, and I had 74 one-on-one meetings. And there's obviously, you know, for some companies, especially the smaller ones, it seems that hope is their business strategy. But then when it comes to the large caps and also the royalties and streamers, I you know, as a kind of a value investor, it really, you know, I really got excited. So I'm seeing pristine balance sheets. I'm seeing management teams that really focus on shareholder value, buying back stocks, increasing dividends. Debt burdens have been released significantly, and I think there will be some spectacular M&A news coming out over the next couple of weeks. I think that the majors will use their financial capabilities to make good acquisitions. Hopefully at the low point of the market, because most of the time those big acquisitions are made at the top. And I just see that, you know, there's very, you know, I'm following the mining space for 15 years now, and probably I've never seen the mining industry in a better shape. For the large caps, especially for the developers, it's tough out there because, you know, costs of capital are rising. Then we're seeing, of course, risk appetite isn't that good anymore compared to the, you know, a couple of months ago. And then obviously, if you produced a PEA a couple of months ago, well, actually, you know, it's worth less now because costs are rising that dramatically. So that's a tough spot. Companies developing projects now going into production in 2030, whatever, they will face a hard time, but still, great projects will always be built, and there's quite a number of really good projects out there.
Ronnie, I'm going to digress now. You have a very vast book collection. What's your favorite business book? Is there one book that you've read 2 or 3 times?
There's many books that I read a couple of times, and actually, I think it's like reading a book just once is like listening to a good music album just once. You know, the more often you hear it, you know, the more you appreciate all those fine details. And it's the same with books, and especially if you develop as a human being. There's a couple of books that I read like 10 times, and every time I learn more about it. I think one of the best ones out there is The World of Yesterday by Stefan Zweig, where he describes the hyperinflation in Austria and then the hyperinflation in Germany 100 years ago, 1923, and what inflation does to a society. Actually, I think that's a fabulous book. Then obviously Lords of Finance is a fantastic book. And then there's, I mean, that's a pretty light reading. That's Modern Central Banking Simplified. And it quotes former chairman Ben Bernanke and says, the US government has a technology called a printing press, or today its electronic equivalent, that allows it to produce as many US dollars as it wishes at no cost. And I got this book from, I don't know who sent it to me. It was like a reader of the In Gold We Trust report, and I thought it's pretty interesting. And it says, print money, print money, print money, print money, print money. And at the end, it says, keep on printing. And actually, it's really financial or modern central banking simplified. And again, I just don't see that there's really, I just don't see this hawkish narrative playing out. I think they are playing this role. They're playing this role very, very well. But now, as so many markets are actually breaking, they will make the pivot, and I think, you know, their next measures will be much more aggressive. So actually, I think this is a very timely read at the moment.
Ronnie, that was a fascinating discussion, and I want to thank you for making time for us today. I would encourage all of our viewers to check out the Incrementum website. That's incrementum.li. It has a wealth of information pertaining to all things gold, including the Bible and Gold We Trust, which is free. Once again, Ronnie, thank you.
Thank you very much. I really enjoyed this. Thank you very much for having me.